morning, everyone. Good afternoon, good evening, depending on where you're joining us from. My name is Peter. I run the Insights team here at Carta, and I'm super excited to walk through our latest data on what's going on inside of VC funds this morning with you. A couple points at the top. Please drop questions into the chat as we go through all of these data slides. Would love to hear what you're seeing, what you're feeling, the big questions and comments that you have on what we're presenting this morning. I'll try to weave those into the presentation. Also, big thank you to the dozens and dozens of you who submitted questions before this virtual event kicked off. Unfortunately, we're not going to be able to get to all of those, but I did pick a couple that I thought were thematically consistent across the Q&A, and I've prepared a couple data slides special for those in the back. So, without further ado, let's jump right into the presentation. This is a slide from our lawyers. I'm required to kick off this way. I think it's a great way to begin every one of these events. Thank you, lawyers. And big news from us. If you haven't heard, in the last month, just very recently, we actually acquired a company called AxleX, who builds wonderful technology specifically for institutional limited partners. So we've relaunched this product as Carta LP Portfolio Analytics. If you are a limited partner contributing capital to venture, private equity, real estate, any private asset class, we would love to talk to you about making your data world a little bit better, from document acquisition, extraction of key fund terms, and then some wonderful analysis. As a chart guy, I think that these analytics are pretty special. So please, if you're an LP, give us a shout. We'd love to chat with you about your data problems. It's a wonderful new product from us at Carta. Let's jump into the data. So this is all numbers that we have recently put out in our Q2 fund performance report, and it covers nearly 3,000 US venture funds. As you can see, the universe of venture funds that we're discussing is generally noticed as the emerging manager class. So funds that are raising from $1 million to call it $100 million form the bulk of the data set here. But of course, there are many funds in the $100 million to $250 million category, and then some bigger funds up to, yes, billion-dollar funds are also on the platform, 62 of those in the 250 million plus slice of the data. On the right side of this chart, though, this is the interesting part. So you've got this dry powder analysis. So the sort of empty box with the lines is how much powder they had to begin with, and then the orange slice is how much is still, quote unquote, dry to be invested across the asset classes. So pretty similar depending on the fund size. This is vintage years 2017 to 2025, so it's quite a few funds. But let's dig into that a little bit more deeply and just break it out by vintage year. So as you can see, a lot of VC funds got started and started committing capital to companies in 2021 and early 2022. No surprise there. That was our last boom. But if you look at the dry powder parts of these bars, I think it's pretty interesting to see that, as expected, if you raised your fund in 2018, you've got very little capital left to commit to new companies. It's been a long time. However, in 21 and 22, some of those funds still have a decent amount of reserves left. Some of that is obviously being reserved specifically for follow-ons, but a lot of that is actually just uncommitted capital because the pace of deployment slowed down so quickly in late 2022 into 2023. So oftentimes the advice that I have to founders is that you want to be pitching VCs who definitely still have capital to invest. Today, that actually might apply to some funds raised in 2022 and certainly those in 2023 and 2024 as well. When we look at the size of these funds, how is that mix changing? You can see that, in the boom times of 21 and 22, you can see a slightly bigger increase in the $100 million slice of funds that receded a bit in 22 and 23, but it's kind of back to where it was in the boom times in 2025. So there are small funds being raised and there's massive funds being raised. I wonder what's going to happen to the middle of venture. The under sub $100 million class, I think, is going to have emerging LPs committed to it. The mega funds, as we know, take on a higher and higher percentage of capital every year, it seems. So what's going to happen to the $100 million to $500 million venture fund? I think that may be the hardest part of the market as we look at broadly what's going to happen, say, at the end of this year and then into 2026. And when we looked at the LP count, one of the things that fund managers always ask us is, how many LPs should I expect to have in my fund? And then the follow-on question is, what does the anchor LP look like? Who are they? How much capital are they committing, et cetera? From our data, there's not a really clear pattern here. As your fund gets bigger, typically you have more LPs. That's not a surprise. But the number of LPs is highly variable. So if you're raising a $100 million fund today, maybe you have 50 LPs. Maybe you have 80 LPs. Maybe some of you are far more concentrated and have only 20 LPs. There's a really sort of shifting mix. It doesn't have a clear pattern here as to what's going on with the LP count. However, there is a clearer pattern when you look at the number of LPs, which is they've kind of decreased over time. So in the boom times, far more people, especially high net worth individuals, small family offices, were interested in committing to the venture asset class for the first time. Candidly, many of those LPs are probably feeling a little bit burned given the lack of distributions, et cetera. I know 2021 wasn't very long ago, and it's a misunderstanding of the asset class to have already expected distributions. But hey, maybe some promises were made that were not kept. And now we're seeing a really sort of a retrenchment where if you were more of a tourist LP or this was your first time in venturing into venture, maybe you haven't recommitted to that fund too. Whereas the standard LPs that have been in this asset class for a long time understand the ebbs and flows of the ecosystem, and they're still willing to anchor new funds. Overall, I'd say it's a more challenging time than it has been in a while to find net new LPs in the asset class. Finding LPs that are already committed to the asset class, I think, is something that many funds are still able to do. And when we look at the checks from those LPs, how much money are they actually contributing to these funds? It's a bit of a complex chart here, but the net takeaway is this. On average, the anchor LP takes about 20 to 22% of a fund, especially the $100 million or less funds. That is up from about 16% on average in the boom times. So your anchor LP is probably going to represent a pretty sizable chunk of the entire committed capital of the fund. And finding that LP definitely unlocks the smaller checks that you'll need to fill out the raise from first close to final close. So if you can find that anchor LP, and I know this is not an easy task by any means, it really does help kickstart the rest of the fundraise. All right, so that's on the fund construction side. It's now time to dig into the actual performance. So I was recently at the Raise Global conference here in San Francisco, had a wonderful time meeting a ton of LPs and emerging GPs. And the number one question I asked all the LPs when I was there was, what do you want to see in these decks? What are you looking for in order to make a decision about whether or not you even want to continue on a conversation with this emerging GP in most cases? The number one thing they said was, show me the performance. Obviously, if you're on fund one, there will be no performance. If you're on fund two, hey, maybe fund one's performance is kind of immaterial because it's only 3 years in and you don't really know how it's going to sell or continue to grow over time. Be that as it may, almost every single LP that I asked was, you need to start your fund deck with some idea of performance. So IRR, TVPI, DPI, do not show gross figures, only show net figures. It's kind of the blanket response that I got from basically every LP that I talked to. So what is good? What does good actually look like in this world? This is net IRR by vintage year, and each one of the dots is a percentile benchmark. So you've got 25th, 50th, 75th, and then the orange dot 90th or top decile marks for IRR in these vintage years. So two things jump out immediately. One, this is kind of a silly chart comparing vintage years against each other because, of course, they've had longer or shorter to mature. And so therefore, the marks in comparison to one another in this view don't make a ton of sense. Be that as it may, you can see that there's sort of this barbell where it goes, or the hourglass figure, higher in 2017 in older vintages, into 2021 where the marks have been really challenging, and then back out in 22, 23, 24, where some of the early markups for these AI hot rounds have caused those 90th percentile IRRs in recent years to really spike. You get a big boost in IRR if you get a markup in the first, call it 18 months of a company's life cycle. So let's show some better charts in my view. The left side of this shows the performance on a median net IRR basis for each one of these vintage years. And the x-axis is just the number of quarters since the vintage began. So in this view, we can actually compare apples to apples. How is a vintage doing at the same time dilation as the prior vintages? So if you just look in that 2021 number, it's 0.1, just over 0% IRR. It took that vintage 14 quarters to get to a positive territory. If you look at 2020, 19, 18, 17, et cetera, those vintages were all positive within maybe 6 or 7 quarters at the latest. So 2021, to no one's surprise, given that it was the hottest part of the market and valuations were highest, is really struggling as an entire vintage year to come close to the performance on an IRR basis of the earlier vintages. It's just really, really challenging to outperform the water that your fund lives in. If there's one takeaway here, and I hope that LPs feel this way as well, investing into venture demands vintage year diversification. There's no real telling which of these vintages are going to be the outperformers. I know, by the way, that there's a theory out there that says because we've been such a downturn in venture in 22 and 23, those will be fantastic vintages to have invested in because the valuations were lower, the hype was less, et cetera. I am very hopeful that that's true. I don't know if we have necessarily data to prove it yet, but I do think that some of the more recent years, 23, 24, 25, have a higher likelihood of outperforming the boom time of 2021. I don't want to get into whether or not we're in an AI bubble yet. I think that's a whole different presentation. Hopefully we get to touch it at some point. But you as managers, you're not shooting for median. That's not good enough. You want to be top quartile or top decile. So this is the data for top quartile net IRR. And again, you can see 2021 kind of flat for a long time there. The boom times and the run up in all these vintage years, and then equally interest rates changing and the downturn in all those vintage years, basically hitting at the exact same moment in time for every one of these vintage years. So 2017 number right now, 18.7% IRR is the top quartile for that year for US vintage funds. Whereas 32% is the top decile of vintage funds. So of course, getting into the top quartile in venture is good, but it doesn't guarantee you much. Getting into the top 10 or 5% really is where the outliers will lie and the power law starts to take effect. So some of these vintages shot up like in 2020 and then have experienced a real significant decline, whereas others are just kind of on a gradual trend upwards over time here. But you're probably asking, this is a vintage year analysis. I like it. It's useful. But what if you split it by fund size? So you have vintage on the one side and fund size on the other. We can certainly do that. On the y-axis is the vintage year, and on the x-axis is the fund size. And what I did here was break out each of the benchmarks, 25th, 50th, 75th, and 90th. And then I, within that, split it by the fund size from 1 million on the lowest end to 100 million plus on the higher end. The takeaway from these charts, which is something that gets debated endlessly across venture, is do smaller funds outperform larger ones? I think the data is pretty clear that at the upper end, if you were in the top decile of a small fund and the top decile of larger funds, the top decile for smaller funds is almost always higher. Not always, by the way. There are vintage years where it's not true. And the difference between 25 million and 75 million might not be that great. But in general, it's true that the top part of the range is higher for smaller funds. What isn't quite as discussed is that the lower part of the range is usually lower as well. It's easier to get a 0 from a smaller fund than it is to get a 0 from a quote unquote mega fund. So the dispersion within this asset class is greater at the smaller end of the AUM, but on a multiples basis, it's obviously easier to outperform on a multiples basis if you are in a smaller fund. Kind of choose your fighter here. If you're an LP, do I want to go with a slightly more sure thing in the mega funds? Do I want to go with a more variable but chance for outperformance in the smaller funds? I think both you can make reasonable arguments for, but if the only thing you care about is multiple, I think smaller funds is where you want to play first and foremost. That's IRR. We're going to breeze through kind of the same metrics here for TVPI. So what does TVPI look like across these funds? Right now, on median for 2017, it's 2x, whereas the top decile is 4.35x. Big gap. And you can see at TVPI basis, the top decile really shoots forward versus the top quartile or even the median. The top quartile is closer to the median in almost all cases than it is to the top 10%. So again, power laws at work here across the venture ecosystem. On a median basis, the net TVPI has perked up a little bit for many of these companies, or excuse me, many of these fund vintages. On a top quartile basis, sort of the same thing. You see a gradual increase. Well, let's focus on the top 10%. So again, most funds are looking to get anywhere above a 3x net TVPI, and then of course, 3x net DPI, hopefully in the end. How many funds actually are up there? The top 10% for many of these vintage years are doing closer to a 3x net. But even in 2019, the top 10% mark is below 3x TVPI right now. There's sometimes a story that we tell ourselves in venture where 3x and top quartile are used sort of interchangeably. I actually have seen this in many venture decks. That's not a true story. In most vintage years, the top quartile mark for DPI in the very end, net dollars back to investors, will not hit 3x net. So if 3x net is really your goal, top quartile isn't what you're shooting for. You're shooting to be top 20%, top 10%, or even top 5% in some more challenging years. Venture is a very difficult asset class for incredible returns over time. Same story here. You can break this out by vintage year and fund size. We've got some very high marks up to the 5x net there for smaller funds in the 90th percentile. Smaller funds, again, can outperform on a multiples basis. And then here's the big one. Money back to investors, real DPI in the ecosystem. What does the benchmarks look like there? Well, obviously, if you're in the first 4 to 5 years of a fund's life cycle, you really shouldn't expect any DPI at all. The fund is too immature. The companies have not had long enough to raise subsequent venture rounds, to experience M&A events, or certainly to IPO at the higher end. So the 0 marks for recent vintages, I think those make complete sense. As you get to about 2017, which is of course 8.5 years ago now, you start to see some real differences in performance. So the top 10% of funds in the year 2017 are showing a nearly 2x DPI back to investors at this point. That's pretty good. The venture fund life cycle, we can debate what it is. It used to be a 10-year life cycle. Now I'd probably posit it's more like 15. So if you're 8 years in and halfway through, a 2x back to your investors, that's doing some really serious work for your IRR and for your LPs. And I think this is where the story around liquidity comes into play. Many of your pre-submitted questions were around liquidity. This is an interesting chart because it just shows what percent of funds in every vintage year have given at least $1 back to LPs. Not 1x, but one single dollar. Now, that's obviously not a good indication of whether or not the funds will end up being great funds or poor funds. But what it does give you is a bit of a sense of the psychology around getting liquidity back to LPs. Look at that 2019 mark. Look how quickly it's shot up in the last 6 months. What I think is happening here is that GPs are listening to LPs and they are trying to manufacture, in some cases, liquidity back to those investors. Now, open question as to whether or not that is the right approach for final fund returns. I'm just saying that it's happening a lot across the ecosystem. Every one of these vintage years in the last 6 months has seemed to perk up pretty steeply as the percentage of funds that are giving even a little bit of cash back to LPs has increased. So the pressure that many of you are feeling about getting money back to investors, just know that that is happening across the ecosystem. And many of your fellow GPs are responding to it with changes to the way that they're thinking about distributions. Kyle has a question here. Is DPI net of fees? Yes, it is net of fees in this case. So that's the performance. IRR on one side, TVPI, DPI, the 3 key metrics that every LP is going to track. But of course, your performance exists in the broader context of the world of venture. So what's been going on across venture? Let's dig into that. First things first, fundraising on an aggregate basis has started to improve. I've stripped out a couple of the mega VC foundational model rounds here because we can debate whether those are real venture. But even when you do that, it's been a, decent venture year in terms of fundraising. Probably going to end up being better than 24, better than 23, but nowhere close to the boom times of 2021. So there's venture capital being committed to companies. How is that capital actually getting deployed? Well, candidly, a lot of it, even today, is going into bridge rounds. So look at this percentage. This is just the percentage of total rounds in every stage that were bridges instead of new primary rounds. In some ways, I think this speaks very highly of you as VC managers in that you are willing to double down into companies that you've already bet on, because most of these bridges are led by insiders already on the cap table. On a financial basis, I gotta say, bridges are a tough conception for me. A lot of times you bridge a company because something didn't go well, and the percentage of those bridges that actually end up carrying the company to the next round or carrying the company to an exit, they're few and far between. So while these percentages seem quite high, I kind of expect them to decrease in the second half of this year, and then in 26 to get back down to more normal percentages of bridges as fewer and fewer companies hopefully experience this difficult middle patch of venture. And one of the reasons I think that is because the down round percentage is finally starting to decrease. If you fund a ton of companies at overvaluations in 2021, it's probably no surprise that you see a lot of down rounds in 23 and 24. 1 out of every 5 rounds on Carta was actually a down round last year. But in 2025, that's really started to decrease. We don't have the Q3 data fully done yet, but I think it's going to come in right around 14 or 15%. That's pretty great. That's much better than it was at 20. And then, of course, we're going to get back down more towards the normal, call it 10% or so of down rounds across the ecosystem. So 2 things here. The stigma against down rounds is kind of silly in many cases. It's much better to take a down round that's clean than perhaps a structured flat round in many cases. And 2, I do expect this to continue to decrease as we're moving forward. There's some questions in the chat about the success rate of bridge rounds. Yes, I have data on that. We're going to get to that in a bit. One question that comes up in the chat that I think is really great, I want to answer now actually, is are the TVPI or markups based on underlying price rounds and non-priced included as well? Across the vast majority of Carta venture funds, they are not upping the valuation based on safes or convertible notes. I completely agree with that strategy, and almost every single LP that I've spoken to has the same opinion, which is a markup based on a single safe is not a good markup. Now, you can make distinctions here. If the markup is from a tier 1 fund that is functioning in place of a primary round, et cetera, et cetera. There are, of course, tails to this. But in general, I don't think that marking up your book based on a safe with a very high valuation cap is best practice. Obviously, each fund can kind of decide for themselves what they want to do and how they want to explain it to their LPs, of course. One of the things that we look at all the time is how long is this journey taking, right? What is the median amount of time between these rounds? It got very high. Look at that number from Series A to Series B, taking 900 days on median. If you split that median apart, of course, there are companies that are raising very, very quickly. And then there are companies that are taking quite a long time to raise. Entrepreneurs often think they'll be in the first category when they end up in the second, and then they have to make some really significant changes to their business. So if you're advising your entrepreneurs about how to think about fundraising timelines, my instinct is to say you want to be a little bit cautious here because oftentimes it takes much longer than you would have expected. And then you have graduation rates, another important key statistic for yourselves as funds to benchmark your fund markup rate versus the general markup rate out in the ecosystem. This is a bit of a confusing chart, but if I want to narrow it down real quick, what this is highlighting here is what percent of companies got from seed to Series A in 2 years or less. The y-axis in this case is just when did you raise your seed round? And then the percentage is codified by color there in the middle. In the boom times, 40% of companies were jumping from seed to Series A in less than 2 years. That's probably too high. In 2022, or for 2022 seed rounds, that dropped all the way to 16%. And so I think we're starting to climb a little bit back out of that, 20% in a recent quarter. I think a good number here is probably between 20 and 25% or so, maybe slightly higher in an average year. So this is getting slightly more healthy. And if you look at the same data, but instead of seed to A, you go A to B, this does not count bridges, it's just primary rounds only. You see somewhat of a similar pattern. Actually, getting from Series A to Series B is a little bit harder in some cases, even still. We're seeing about 15 to 18% of companies do that in 2 years or less. So again, we read about all these AI high flyers that are going from seed to A to B in what feels like, 18 months. That is not the real world for most venture-backed companies. So to predicate your fundraising strategy on what you read in the most recent TechCrunch headline, probably not a great move. Florin asked an interesting question, which is the median time between rounds impacted by the number or need for bridge rounds? I think they're intimately connected, yes. I think a lot of companies got started and had an expectation that they were going to raise every 2 years, and then the market moved underneath them, and they're getting swamped in some cases by AI native competitors that are just growing faster, and therefore they go back to their current investors and ask for more cash. I think that's happening a lot across the ecosystem, and it puts those initial VCs in a bit of a tricky position. Do you commit more money to your initial bet with that company? Do you have some tricky conversations about not wanting to put in more cash? Do you kind of lead a charge to go bring in other investors into this opportunity? It's a core part of being a VC, which is saying no to people you've already invested in. And it's not an easy choice. These are difficult and emotional conversations in many cases. So that's the context. That's the fund performance data. All of this, by the way, is available in the fund performance report that we published a few weeks ago. But when you want to wrap it up into a theme, what is actually happening these days in venture? I think 2025 can be summed up in one word, which is concentration. And I want to unpack that in a couple of different ways. The first one, the one that we're all kind of sick of talking about, is the AI boom. How much money is going to AI startups specifically? So this is just a graph of the percent of capital in each stage that is being deployed into AI startups. 70% of the late stage rounds on Carta this year have been AI startups. It is the trend across the ecosystem. But that applies to seed stage, that applies to Series A. All of these bars generally are going up. The black part of this chart, by the way, is before ChatGPT, and the orange is after ChatGPT. I just think that's a useful dividing line. Now, is this an indication of hyper concentration or a bubble? Depending on who you talk to, you get different opinions. What I think is starting to happen, though, is that there are very few companies, at least software ones, that are being started today that don't incorporate AI in some way, shape, or form. So how useful will this chart be in 2 years, where 95% of the deal flow that venture capitalists are seeing have incorporated AI into their tech stack? AI native versus AI enabled is a distinction that some funds make, but some funds don't care about. So I'm hopeful that this isn't a chart that we have to keep putting out for another 2 years. I'm hopeful that it sort of runs its course in a little bit. So on the theme of concentration, the left side of this chart is total cash. The right side of this chart is total rounds for seed and Series A. And I threw in the safe rounds that we would qualify as seed as well. So more money over the last 3 years going into seed and Series A rounds, but fewer actual companies raising. You see this across many data sets in venture. This is where I think you start getting into the concentrated part. In 21 and the boom times of 21, more capital, more startups, basically in tandem. In 2025, it's more capital, but fewer startups actually getting funded. So venture is taking more concentrated bets. How will those bets turn out? We'll check back in 10 years. But we'll actually know well before then. And we'll talk about it, of course. Corey, great question. How are we defining AI startups? So we did two things. We asked the founder, are you an AI startup? And they told us. Good definition, you decide, maybe not. But then we did a lot of third-party research on our end and checked. And what we wanted to see was, is your service, products, startup predicated on the use of AI technology? Now, that is a very broad definition. And when I talk to venture investors, some of them only want LLMs that are building their own foundational model. Some of them want the application layer that is using LLMs to transform an industry. Some of them only want proprietary data startups that can fine-tune a model. It's all over the place. So we were pretty broad in this definition of AI. What we have seen is that the split between infra on one side and application on the other, there are more VCs who are funding the application layer than there are funding the infrastructure layer right now, but only because the infrastructure layer is taking such massive rounds that it really limits the participation of very small funds in that part of the sort of AI ecosystem. But yeah, we could have a long debate about what's included and what's not on each one of these. So another theme of concentration, early stage rounds are increasingly being taken more and more by a single investor. So the median ownership for the lead investor in a seed round used to be about 50%, and now it's over 60%. And you see a slightly similar, although less dramatic change in Series A. So I think that this is indicative of two things. One, bigger funds coming down into Series A and seed who are willing to be more price insensitive and will buy up a bigger allocation of the equity that's available in the round. Two, smaller funds doing exactly the same thing, actually, because they feel a little bit nervous about their ability to layer in on a pro rata basis or do follow-ons into those companies, given the presence of the mega funds. So if you are not entirely certain about your ability to follow on into a company, it makes sense to try to own more of that company up front. So in, TLDR, early stage is getting more sharp elbowed than it has been in a while. And then we get to the bridge question. So, Peter, you asked a question earlier around, are bridges good? Do we have success rate stats on bridge rounds? We do, and they're not pretty. So this chart is a little complex, but here's what's going on. The orange dots in every one of those lines are the percent of seed companies that got from seed to A that needed a bridge. The black dot is the percent that got from seed to A and didn't take a bridge. And so you can see basically at every cohort, there are more companies that graduate without a bridge than graduate with a bridge. And this probably makes intuitive sense. You wouldn't bridge a company unless they sort of needed it, right? It means something went wrong. And if something went wrong, it's less likely that they're going to make it to the next round. So this to me was fairly obvious. What's interesting in the last couple quarters, big change, is that the companies that are taking bridges, a higher percentage of them have actually made it to the next round already. And so the story that I keep hearing from GPs across the ecosystem is, Peter, these aren't bridges in the traditional sense. We're not worried about these companies. We are trying to get as much capital into them before the Series A as possible. They're preemptions, not bridges. And so again, that feeds the concentration narrative. When a VC finds a company that just smashes it, even 4, 5, 6 months after they raise the seed round, sometimes they're going back to that founder and trying to put more money into that company before they raise a big Series A. I used to think that that was kind of a story that VCs told themselves, but I think it's actually pretty true right now in the ecosystem that it's happening more and more frequently. And then the last part of concentration is, of course, geography. The Bay Area, in our data, remains completely dominant in startup funding. Basically, 40 cents of every dollar that's invested into startups is going to a Bay Area startups, or it has, over the last, call it 12 months or so. Number 1 in AI, number 1 in SaaS, number 1 in hardware, number 2 in biotech, knocked all the way down to 2, and health tech, fintech, consumer, etc. Now, I don't know whether or not this specific percentages will continue, right? I do think that there are more places across the US that you can start a VC-backed startup than there ever have been. There are really thriving seed and Series A ecosystems. But late stage cash really does concentrate itself in the Bay and New York specifically. So you can get started anywhere, but if you're trying to raise the mega rounds, those are really still Bay Area phenomenons. And again, if on this concentration theme, if you're looking for the biggest valuations, you're also basically coming here to San Francisco. No judgment as to whether or not these are good or bad. In 2021, there was a ton of high valuations. Many of those companies were completely overvalued. So I'm not saying whether or not this is good or bad for the business. But if you are looking for a top 10% valuation as a founder, 44% of the top 10% valuations live in the Bay. So, and this is at seed. So there's a dispersion that happens here. There's a concentration of capital and a competitiveness amongst the most in-demand founders that happens within the Bay Area dynamics that just doesn't happen other places. Again, no judgment on whether or not that's good or bad for ultimate returns. You could make the case that the best founders are here and you got to get into those rounds. You can make the case that San Francisco companies are completely overvalued and you shouldn't get into those rounds. Both of those are fair cases. But there's no denying that if you're looking as a founder to raise at the very highest valuation for some reason, you should move to San Francisco. That's pretty clear. Whether or not that's good, that's up for you to decide. Daniel asked a great question in the chat about, are startups migrating? Are they moving to where the capital is? It's tough for us to see this. I think the answer is anecdotally, some of them are, but I don't think that tons and tons and tons of startups are moving to the Bay after they've been started. The founders might be moving to the Bay before they start and then just actually begin their companies here. But I candidly don't have the best data on that. So I'd love to read more data on what's happening on that side. We've got about, call it 5 to 15 minutes left together here. You all did submit some cool questions, so I want to get to those answers right away. But if you have other questions, throw them in the chat. We'd love to talk about them. For the GPs on the call, of course, hope you're familiar with Carta's complete suite of fund administration tools here. We're serving 2,500 venture funds, 10,000 entities from all the different kinds of SPVs that you might have in your fund strategy, and then $150 billion of assets under administration. So this is a fantastic time to be joining Carta as we kind of reimagine what it means to be part of a private capital ecosystem. And then, of course, as I mentioned, I personally am super excited about this new LP product, LP Portfolio Analytics. We're going to have a ton of data that's also aggregated and anonymized alongside the venture data. So hopefully we're going to start to be able to do some really cool comparisons between private equity, venture, private credit, all those kinds of things. So if you're an LP that invests into alternative assets, again, we'd love to talk to you. But let's get to your questions. Your first question, this actually was, somebody wrote this, I think twice, and maybe it was two different people or the person submitted it twice, which was interesting. Do seed stage founders get anything of value from mega funds investing in their seed round beyond the brand name? So obviously I don't have a lot of data on this. I'm not sure exactly how you could, unless you interview, 1,000 founders on this question. I think that the age-old debate between the value of an emerging manager who's very close to the company versus the value of a brand like Sequoia or Andreessen who can provide network effects to the company, you can make really credible cases on either side. So this question kind of posits that the brand name is all they get. The brand name does a lot of work sometimes. Opens doors to the right people, helps you hire, makes you a more credible company to corporate enterprise customers. There's a lot of reason why that brand name is actually really useful. But of course, on the other side, are you just going to be one of an option call pool of bets and you're easily discarded by a mega fund, whereas the emerging manager GP will put in more blood, sweat, and tears to make your company work? I think that is a great debate. And I think it's one that oftentimes emerging managers are still winning. So I don't want to make this all doom and gloom about the mega funds coming in and sweeping up every quality deal in venture. That is not the case. And many of the most consensus deals don't end up being the ones that are ultimate fund returners. Other question, how much in terms of a percent of capital should a smaller pre-seed or seed fund allocate for follow-ons? So traditionally, this question has been answered usually about, 50-50 or 60-40, 60 committed to the initial checks, 40% for follow-ons. That was pretty standard. Over the last, call it, year or so, we have seen some smaller funds on Carta decrease the amount of capital that they've allocated for follow-ons. So this chart sometimes gets me in trouble on LinkedIn and other places, but it is just a model. It is not the real world. There's tons of problems with it. But there is a slight trend for some funds to go with a slightly higher initial bet count, meaning they invest into more portfolio companies up front and they reserve less for follow-ons. This is not everyone. There are tons of managers who believe very highly in the concentrated model and are reserving about half of their fund because they know or they expect to need to follow on into those rounds. But on the initial question, I think one of the biggest considerations to have here is you need to keep track of those round sizes. So if you are a $50 million seed fund who's writing, call it $2 million checks, a Series A these days is going off at $11 or $12 million raised. So you would have to commit $6 million to lead that Series A. That is a massive portion of your follow-on capital. Then as these rounds continue to grow, either the fund sizes at the early stage might need to grow to have follow-on opportunities, or perhaps you reserve a little less for follow-ons and you actually raise special purpose vehicles or other kinds of funds to invest into your best opportunities. We're seeing funds do both approaches, but I would say on median, I'd say funds are reserving a little less this year than they have in the last couple years. One of the questions that also came up is, what about structure? What about deal terms that favor the investor in this case? So high liquidation preferences, cumulative dividends, participating preferred stock, ways that the venture deal looks pretty good on the surface, but actually has a lot of strings attached to it. How often are those actually coming to fruition? I'm really happy to say that at the early stage, those just don't exist. This looks at all deals across Carta at seed or Series A, and then how many of them have a liquidation multiple of more than 1x. And even at the worst possible time, the bad quarter of 2023 to begin with, when everyone was very doom and gloom about venture, 3.6% of deals had higher than 1x liquidation preference. So everyone has kind of converged on standard deal terms, which at the early stage, I think makes a ton of sense. You really should not be demanding things from these founders at this super early stage, especially on primary round investments. At the later stage, we have seen a growth of structure in these deals. Some of them might have a 1.5x liquidation preference. Some of them might have participating preferred clauses on the equity. There's a lot of different structure, which I think makes sense for companies that have actually done something already and are Series C, Series D, and beyond. At seed and Series A, just go with the standard clean deal. It doesn't make sense to put onerous terms on these early stage founders. Those were the end of my prepared questions. I really appreciate all of the things that you submitted. I'm going to scroll back now in the chat. Sorry, I haven't been monitoring this as closely. There was a couple comments on mega funds versus early stage funds and the concept of signaling risk. I think that signaling risk, which is, of course, the idea that if Sequoia leads your seed round and Sequoia doesn't want to lead your Series A, nobody will want to lead your Series A. I think it's real in some cases. I think it is a little arrow in the quiver of emerging funds who say, look, we won't be expected to lead your following rounds, so it's not a negative signal when we don't do that. That's true. I think most, at least in-network founders in San Francisco, understand those two positions, and many of them are willing to accept the signaling risk anyways. So I think it's a valid claim, and it's something that you should discuss with your founders or as you're evaluating opportunities. But I don't think it's necessarily always a winning argument, depending on the founder. Deborah asked a really good question around, is there any pushback from LPs on the management fee and carry amount to increase the returns? There hasn't been a lot of change in the initial management fee structure. We still see 2% as the blended amount that you're going to be charging for management fees. Some funds are in demand and can charge 2.5%. Totally. Some funds have more step down periods after the initial investing. There's a mixed bag, but 2% is typically still what we see on a blended basis. The carry amount is actually more variable. There are some smaller funds who are more willing to drop the management fee a little bit and then increase the carry amount with specific hurdles. That turns off some LPs for sure. You're probably not even gonna talk to them because they won't take the meeting. But perhaps they were never going to invest into your fund in the first place. So is it really a loss? Your fund economics will in some way dictate the people that you get access to. So you do want to have some long, thoughtful discussions about it with your co-GPs and others before you go out to the market, because you don't want to be changing the fee structure as you interact with LPs. that's not good. You should come out with a thesis up front for sure. Peter asks a question on exits. Great question. First, this will be the most companies ever acquired off of Carta in a single year. So more M&A is happening. 2025 will be the best year for M&A that we've seen. 2026 looks to be probably even better, at least the first half of the year, depending on what happens with interest rates. The follow-up question, are all of those exits good quality exits? No, not all of them. A lot of them are acquihires or small deals at pre-seed and seed and Series A. Some of them, an increasing amount, are late-stage deals. Doesn't mean that all of that capital is flowing through to the founders and employees, but in general, I'd say that that ecosystem is improving. The thing that's really gating the full liquidity picture is still IPOs. There's going to be 20 to 30, major tech IPOs this year. That's an okay year. It is in no way a bonanza. It's better than 23 for sure, but it's not some sort of wild ride. I think that what candidly is a part of the holdback on that is the best companies, the quote unquote best, the ones that we all know, the 10 names, are just choosing to stay private for as long as they want to. Maybe forever. Forever's a long time, so maybe not, but for many years. So some of the best private companies are just not accessible by retail investors in the public market. And I don't really expect them to go public anytime soon because they can just do employee tender offers annually and they can kind of get liquidity in different ways. I think that's a new part of venture. And it's a little bit unknown what happens to the venture asset class if that's at the best companies, the way that liquidity gets exchanged over time. Aaron, wonderful question. Are LPs pushing back on the extended lifetimes of funds? 15 years versus 10 years makes IRR much less attractive. I think they should be. I think it's really, really underrated, the impacts to IRR that an extra 5 years has on a fund. One of the biggest questions there is, of course, if 3x net was the old benchmark that you needed to hit in 10 years, does 3x net make the same sense in a year in 15? On an IRR basis, it's clearly worse. So I think that is a question that many LPs are kicking around right now, and it makes this secondary liquidity strategy even more important. So if you come in with a thoughtful approach to LPs around your secondary liquidity strategy, around how you are going to thoughtfully take positions off, I think it can make a difference in those LP pitches for sure. Question here about no fee carry only funds. Cowboy, I love it. Let's go. Obviously, there are certain people who can't take a no fee fund. That is a privileged position to be in. But if you are willing to do carry only, I think you'll probably get more meetings with LPs. Remains to be seen if they'll invest into you, but I think it's a good way to open doors for sure. We haven't seen a ton of it, to be honest. So report back, please, and let me know how that resonated, because it's super aligned. Of course, you're in it for the carry only. I think that makes a lot of sense. Yeah, really appreciate all the wonderful questions, y'all. As Molly mentioned, this recording will be live. You can review it at this same link, and we're going to send it out to you afterwards. If you look at the resources tab on the right, you should be able to see the deck and things. But if that doesn't satisfy, or if you have other data questions, you can always email me, peter.walker@carta.com. Happy to listen to any and all of your data needs. And yeah, we host these quarterly. And of course, we're putting out new data from Carta basically every single week. Some good late questions coming in real quick. Round amount through the last vintages. Andre, yes. Rounds are getting bigger. The median amount of capital raised by a seed stage startup these days in the US is $3.5 million. The median for Series A is 10.5. Those are bigger than they've been in a while. So if you are trying to sort of right size your entry price and ownership and all those kinds of stuff, to play in the bigger rounds at the early stages might cost more capital than it used to. And Dave asked a question on recycling trends. I would say yes, on a marginal basis, DPI back to investors is being prioritized a little bit more highly than recycling. Although if you made the right LP, if you got the right LPs into the fund and they agreed to your strategy up front, I still think that LPs are often okay with recycling when it makes sense. So I'm not saying that recycling has gone away by any means. Maybe on a marginal basis, some people are saying if it's a small amount of capital, might as well give it back to LPs, put some numbers on the board. You'd be surprised what the difference between a 0 and anything else is in that DPI column. It can matter up front. All right, and I'll probably end with this one. 2 or 3 key takeaways for fund managers that are in market for LPs right now. So again, some of this is informed by conversations that I've had over a bunch of AGMs over the last few weeks and with LPs, especially at the Raise Global Conference. I think LPs in this market have one good thing for emerging managers and one bad thing going on. On the good side, access to the mega funds is slightly less constrained than it used to be. And many LPs, especially at an institutional level, are already committed to that part of the ecosystem. So on a marginal dollar basis, they are slightly more open, getting more open to investing into emerging managers because they think the returns that I'm going to have, whatever they may be from the mega funds, I've kind of already priced that in. On the downside, so many LPs came to me at Raise and asked, what is the most distinctive early stage fund that you've seen? The amount of fund managers in the market that are blurring together in the eyes of these LPs is ever increasing. So the distinctiveness to your deck, to your pitch, to your access to founders, I think has to be front and center to your pitch. Obviously, metrics matter, but why you in this market? What have you done that gives me reasonable assurance that you will be able to access people that I could not get from any other manager? I think is really clear. And that brings us to the concept of specialist versus generalist funds. I'm not saying that generalist funds are somehow not being funded today. I think they are. But specialist funds, not necessarily say as specialist as I only invest into science professors at big universities who are going to build biotech companies. That's very narrow. But specialists in the idea that there's a slice of the world that only I know really well. That I think is more impactful in these pitches than you might think. So it's oftentimes a bit of a beauty contest here about how to distinguish yourself amongst the 100 funds that they're evaluating right now. Distinctiveness matters a lot. How can you bring distinctiveness up front and center in your pitch deck, in your conversations? And then how do you layer in the social proof of that distinctiveness, in particular with founders? Other GPs vouching for you is awesome. Founders vouching for you is more important. Maybe that was a long-winded response to Andreas's question, but hopefully useful. All right, and we just threw that resource in there. But again, this will be available to you in about an hour after this goes up. And really appreciate your time today, y'all. If you have other questions, shoot me an email. Happy to answer them. And thanks for engaging a little bit with our data this morning. We'll be back again soon. Appreciate the time.